taxation in the manufacturing sector. And even before we do that, probably some welcoming news. On 10th March, that was the day before, that was on Tuesday, KRA gave a circular on special tables, which has been a very major headache on a lot of businesses that transact with VAT. So basically what we've been told is that all the taxpayers on special table, for reasons other than the trader scheme, the missing trader scheme, or fraud or crime, will be removed from the special table, and that was supposed to be unconditionally. They were given until yesterday to remove everyone in the special table unless your case concerns missing traders or fraud or crime. So in case you're still on the special table, please get in contact with your account manager to ensure swift removal to enable you to file your returns as soon as possible. Also, in other communications, KRA has introduced body cams to officers working at the customs. This is a move that is geared towards transparency and to avoid tax evasion, and also to minimize the cases of bribery and corruption in our ports. Moving forward, we can start with a quote from Will Rogers, who basically say that the difference between death and taxes is that death doesn't get worse every time Congress meets. So every time that the parliament meets, when it's about taxes, to a very great extent, it gets worse. So death is better because it's final. Probably that's what he meant. But as far as taxes are concerned, they basically get worse every time Congress meets. Now to our today's subject. Manufacturing is one of the most tax-exposed sectors in Kenya because it interacts with almost every major tax head, which includes the corporate income tax, the VAT income, the VAT tax, customs and import taxes. We have got the excise duty. We have payroll taxes. We have regulatory and industrial levies. So basically, it affects almost all kind of taxes. So apart from looking at the various taxes that affect the manufacturing industry, you should also look at tax incentives and also the KRA audit focus areas, and also the tax risk management checklist. And we shall look at case law just to get a grasp of what income tax is. Sorry, manufacturing taxation in the manufacturing is concerned. In the introduction, we shall look at the nature of manufacturing, but we shall focus solely on tax purposes. We shall look at the governing legal framework, and also why manufacturing is a high-risk area to KRA. So today we not only look at what the law says, we also examine how KRA enforces those laws. So manufacturing involves the conversion of raw materials into finished goods. It is basically a process of value addition, and it is an industrial scale production. And also it involves a lot of importation of inputs, and it's very capital intensive as far as machinery is concerned. And also you'll find that when it comes to employment, it employs a lot of people, from the casuals to the going up until the management. It is usually very employment intensive. That is, so basically you can see why sometimes it can be a cash cow for KRA, and also sometimes it exposes those in the manufacturing industries to a lot of risks as far as KRA is concerned. So the governing legal framework for those taxes, basically there is the Income Tax Act, CAFRO 70. We have the VAT Act 2013, Excise Duty Act 2015, the TPA 2015. We have the East African Community Customs Management Act of 2004. We have the SEZ Act, the EPZ Act, the Standards Act, and also the Finance Act, which basically involves amendments in different areas of all tax heads. So why is manufacturing a high risk for KRA? Number one, especially for manufacturing companies that do exports. Exports are basically zero rated. So you'll find that there's a lot of refund claims. So large VAT refund claims is a risk, basically is a risk as far as KRA audits are concerned, because it will involve acquisition of high value machinery, which will give you a refund state. And also, as you know, those people who are involved in exportation services, they are, when they sell at a zero rate, the input claims that were charged at 16%, they qualify for a refund. So there is that exposure. Number two, we have the transfer pricing exposure. This is basically involves multinationals that are involved in our topic today, that are involved in manufacturing. So there is a high exposure of transfer pricing as far as shifting of profits are concerned. Also, we have the customs valuation disputes. We shall later look at that, on how misclassification and also payment of customs at a wrong rate can lead to assessments. We have capital allowance abuse. As we know, when capital allowances, these are allowable deductions that reduce the amount of profit that is supposed to be taxed. So some manufacturing companies end up abusing it, and which is also gives you a risk as far as KRA is concerned. We have also have thin capitalization structures. This is basically foreign entities. These are companies that have got controlling foreign entities that are heavily debt. The ratio of equity to debt is usually very high. So they end up claiming a lot of interest expenses as far as laws are concerned. We shall have a brief overview on that. Also, we have exercise under declaration. This is excise duty is usually done at ex factory. So if the number of goods produced at the factory differ from the number of excise terms given, then it will be deemed as under-declared, which is tax evasion, and it will give you a lot of issues with KRA. So the first tax that affects manufacturing companies that I'd like us to look at is the Income Tax Act. The income tax, the corporate income tax. Under that, we'll look at the charge to tax, determination of taxable profits, the allowable deductions, the capital versus expenditure distinction. Also, we'll look at thin capitalization, And also for multinationals, we shall look at transfer pricing. So the charge to tax, section 3, section 3.1 of the ITA refers to the tax charged on income on income accrued or derived from Kenya. So section 3, 2, part A refers to the gains or profits from business whose corporate taxes, the resident is 30%. The non-residents, initially they were at 7, and so currently there are 30%. This was basically done to encourage foreign companies to trade more in Kenya. So the allowable deductions. So in the Income Tax Act, Section 15 expounds on the deductions that are allowable. Section 16 talks about the allowables that are not, sorry, the deductions that are not allowable for tax purposes. So as per Section 15 of the Income Tax Act, it specifically says that income expenses that are wholly and exclusively incurred in the production of income are the ones which are allowed or are the ones which are deducted while computing your taxable income or rather taxable profit. Some of the examples in the manufacturing industry of the expenses that are allowable include, we have the raw materials, we have utilities. This include electricity, water, we have steam, we have factory wages, we have repairs, under section 15, 2C, we have research and development, we have insurance, we have interest, which is subject to section 16. There are some limitations of interest expenses that are described in section 16 of the ITA. So you have to be very careful as much as you will be deducting your interest expenses from your profits. They have to be in line with section 16. One of the major misclassifications that usually affects those people who are in the manufacturing industry is the distinction between capital expenditure and operating expenditure. So operating expenditure, it's we look at an example so that we can bring it more home. So let's say, for example, you have a warehouse you are under manufacturing for a case, and you have a warehouse or you have rooms. So you decide, okay, in the beginning of the year, you decide to repaint the whole office. At the same time, no, because you are increasing in the number of employees, you decide to start partitioning. Both of them are expenses, both of them are expenditure, but the treatments are different. For paintings, you're going to deduct them as operating expenses. But for the partitioning, they're going to be capitalized. So while incurring some kind of expenses in the manufacturing industry, you have to be very careful about the classification of those expenses, because sometimes you will end up expensing an item that is capital in nature, which might raise a KRA assessment or KRA review or even a KRA audit, and you'll end up paying the taxes on the balance. So we have to be very careful about classification of both capital expenditure and operating expenditure. So probably the take home under capital is if it enhances, if it increases capacity, if it increases output, that is capital allowance in nature. But if it's just about, if it's an expenditure that just gives it back, or rather restores an asset to original condition, that is deductible as an operating expenditure. So we have to be very careful in the classifications. So if you have any questions, you can ask the questions in the chat box, and we have a very able team, a support team, who are going to answer your questions. Also look at answer some of the questions as we progress. So the common disputes is, if I have machinery and I have upgraded it, you'll find that most, because of the high value of the expenditure, people will tend to expense it, which is wrong. You're supposed to capitalize it. The same applies to production line replacement and also factory expansion. All those, they are capital in nature. So you'll find that there are some entities which are foreign controlled. They're foreign controlled. So basically what happens is, you'll find that such kind of entities, or rather manufacturing industries, the ratio of debt to equity, the debt is way higher. I'll explain in a short while why. In their books, it appears that they are heavily reliant on debt from their controlling entities. So what basically happens is, the company will use a lot of money to repay the loans plus the interest. So if the loan interest expenses are allowed, or rather they reduce the taxable profit. So the higher the debt, the lower the taxes. And put this in mind, these amounts are being paid by a controlling entity. So basically, by extension, these guys are transferring profits which were initially supposed to be taxed, and they are transferring it to the foreign entities under the banner of loan interest payments. So KRA had a look at this, and that is why under section 16, under the disallowables 2, the debt to equity ratio, if it exceeds 3:1, any amounts that exceed the ratio of 3:1 as far as debt and equity is concerned, any amounts above that, they are added back, or rather they are disallowed for tax purposes. So it will be any interest amount of debt that is above the ratio of 3:1 as far as debt and equity ratio is concerned. Any amounts above that, they are disallowed for tax purposes. So that is why there is the restriction of earnings before interest, tax, and debt. So that is basically one other thing that affects manufacturing as far as income tax is concerned, and as far as deductions are concerned. Another thing that affects the manufacturing industry, the transfer pricing, especially for manufacturing industries that are multinationals. So you'll find that some of the common transactions under this, the raw materials which have been imported from the parent companies, the management fees, the royalty payments, and the contract manufacturing margins. So you'll find that most of these companies, they will end up escalating the costs of management, the cost of raw materials and royal payments. This basically, if your cost of sales is high, then it means your profit is high. So you'll end up paying low taxes. So to counter this, Section 18 of the Income Tax Act talks about the arm's length principle. Basically, every transaction is put under the arm's length principle to see if the prices that are charged, or rather the money is paid for costs between related companies, is the same amount that is paid under unrelated entities. So if that is not the case, the balances are usually added back to your taxes, and then you end up paying the difference. So you have to ensure that every transaction, especially if you're in the multinational enterprises, the prices the transaction, the nature of transactions that you are dealing with your parent companies or with your foreign entities are supposed to be arm's length. That is, they're supposed to be the same prices that will be given to a person who's not related. So documentation is required under the transfer pricing rules. So the risk that usually multinationals are, as I've said, is the margin adjustments by KRA. So the margins are adjusted, and then you end up paying that balance of trade. I hope I'm not going too fast. I hope I am not leaving anyone behind. I do hope so. So let's continue engaging. Yeah, let's continue engaging, and we will, in case of any questions, I will not stop asking. That if you have any questions, you can continue asking in our chat boxes. Next, I'd like us to look at the VAT. I'd like us to look at the VAT. You'll find that a lot of industries, unless those transacting with exempt entities, almost all of them, they are under the VAT regime, or rather they have the obligation of VAT. So Section 5 of the VAT Act 2013 provides that the standard rate will be 16%, and the threshold will be 5 million. So under registrations, we have got various types of registration. We have the voluntary, we have the compulsory, but that will not be our focus today. We'll just look at the input VAT deductions. So basically how VAT works is they take your sales for a particular amount, which is classified as the VAT output. And then also you take the cost of the goods when you are purchasing them, the value of the inputs of when producing your goods. So you take the outputs, you less from the cost of the inputs. So the balance between the two is charged at 16% if it's a standard rated item. But now for your input to be allowed, for your input deduction to be allowed, number one, it's supposed to be supported by a valid tax invoice. Number two, it is used to make a taxable supply. So in the first instance, Because of the rise in the number of missing traders, during verification, a valid tax invoice is not enough evidence of a transaction. So to support this, you're supposed to have other supporting documents to support that transaction. Some of the documents include the LPOs, the delivery notes, and the proof of payments. So if you have a tax invoice and you do not have the rest of the documents, if KRA decided to do a review on you, then that invoice is going to be disallowed and you'll end up paying the taxes of the inputs that you had claimed under that invoice. Number two, they are supposed to be used for making taxable supplies. Now, for the sake of a reduction of the VAT liability, most of us have literally decided that whichever transaction that they're going to make, they are going to claim VAT from it. So what KRA will ask you, you are running a hardware, and under your claims, you have household goods, and then you're claiming them under your inputs. So the question is how, KRA will ask you, how does selling of cement relate to your household goods? So you have to be very careful. You go ahead, you buy, let's say you are refurbishing your house, you buy a set of sofas at around 200,000, then it has VAT, and then you end up claiming them under your VAT inputs. So as much as we would want to outsmart the system, you might get away with it for some time, but not forever. So to avoid all this, to avoid accumulation of paying those taxes and their penalties, let us try as much as possible to be compliant, because KRA will only rely on the law, will basically rely on the law. So if it was not used for making taxable supplies, then it will be disallowed. If your invoice is not supported with the delivery notes, the LPOs, and the proof of payment, then that alone is not sufficient. Then also something else that is mandatory is the e-teams invoices. So as much as the teams invoices are being phased out, currently all invoices are supposed to be e-teams. But even if you have teams, it is still allowable, but they are being gradually phased out. So all your invoices, for them to be claimed as VAT for input deductions as far as VAT is concerned, they're supposed to be ETIF generating. Also, another aspect that KRA introduced is supplier input is denied if, number one, your supply is not compliant. If your supply is on the special table for whatever reason, you cannot claim that input. So basically what KRA did, it shifted compliance to even the buyer. We actually do not know how fair that is, because one of the principles of laws is fairness. But basically that is what KRA did, it shifted compliance risk to the buyer. So and also another thing, if the invoices are not validated, that is, here it is an e-teams invoice, but the person that you're buying from, the invoices are not being submitted to KRA. So it is also, this is a risk that you're supposed to ensure that all your invoices have been validated. How you can do that is all eTeams invoices have a QR code at the bottom. Those QR codes are not for decoration purposes. The QR codes are used to confirm. They're used to confirm if the invoices are valid or not. So you just take your phone, you scan that QR code. It's supposed to give you the details of the invoice. If it doesn't, then it means the invoice has not been submitted to KRA. It's supposed to bring your PIN, the amount of value in the invoices, and also the details of the invoice. Failure to do that, then it's not validated, and you cannot use that to claim your inputs as far as VAT is concerned. Under VAT, we have got the zero rating and the exemption. This is basically the first and the second schedule. The first schedule talks about exempt, then the second schedule talks about zero rated. So zero rated, all exports, exportation of goods, exportation of service, exportation of vertible goods, exportation of services, they have VAT but at 0%. So if you are dealing with vertible goods, are you supposed to register for VAT? Yes, you are. But the difference is you're going to charge, your sales are going to be taxed VAT at 0%. That basically means if you incur the cost that you incurred, if your inputs had VAT at 16%, and then your output has VAT at 0%. So basically it means the amount of VAT you're supposed to pay is 0 minus 16. As we said, it's input minus output. That is minus 16. So to bring it more home, if I am exporting, if I'm exporting goods, let's say I'm selling an item as 200 shillings, which is taxed VAT at 0%. At the same time, my inputs were the cost was 100 shillings. So the difference between 200 and 100, that is 100 shillings. So the 16% of 100 shillings, this is the amount that I incurred during production of that good. But I have sold the good at a rate of 0%. So basically what that means is I will for all the inputs that I incurred, the VAT that I paid on them, I'm supposed to be refunded by KRA. Hope that makes sense. For zero rated, you qualify for a refund. That is, if your inputs were vertible, you can recover your VAT. But now for exempt, it's different. For exempt services, there's no VAT charged. So if there was no VAT charged, that means even if the input that I incurred in production of the exempt good, I will not be able to recover that VAT. So if I do not charge VAT, then I cannot recover the VAT. If I charge the VAT at 0%, then I incurred an input of 16%, then I qualify for a refund. I hope the point is home. So we have talked about VAT refunds, especially for those in the exporting business. So manufacturers who do exportations or exporting both goods and services often in most of the time are in a refund position. Or you'll find that they're in a perpetual refund claims as far as VAT is concerned. Because if there is heavy input and the output is exempted, is zero rated, so at the end of the day, you'll find that you're in a perpetual refund position. But some of the risks that affect VAT refunds are delays in the refunds. We have audit triggers. The audit triggers can be created by, let's say, if there are a lot of large capital purchases, which were charged 16%, so you end up claiming them. Also, if your rate of refund is rapidly growing, KRA will become curious as to why is there a sudden change? Why is there a sudden change, or rather, why is there a very rapid growth in the refund claim? So they're going to audit you. Also, your suppliers. If some of your suppliers are questionable, then it will raise by extension an audit risk for you, or a trigger for audits for you. But most of the time you'll find that, especially delays, they give a lot of manufacturing companies a lot of financial strain, because if they are delayed, then it means KRA is holding a lot of your money, which will bring cash flow problems in the manufacturing industries. Because for those in manufacturing, if I can ask, how many of you have refunds older than 6 months? So you can imagine if for 6 months KRA is holding your refunds, at some point it will strain your cash flow. But as far as refunds are concerned, some of the things that are usually asked for, because especially for the initial refund, KRA will want to do an audit to see if your refunds are legit or not. So if there are import entries, it will be required. Also the export documentation, the supply invoices, and also stock reconciliation for your refund to be processed. So especially manufacturing industries which are in large scale, you'll find that they import most of their materials for manufacturing. So we have got import taxes and also the custom taxes. So we'll look briefly at them, at the customs and import taxes. So they are guided by the East African Community Customs Management Act of 2004. The import taxes include the import duty, import declaration, and the railway development. The import duty varies between 0 to 35. It is very important to know how to classify your goods and in their correct HS codes. Because let's say if the good that you are importing was supposed to be, the import duty was supposed to be 20%, but you for the longest time you have been importing it at 15%. So in case of an audit, the 5% on every item plus interest and penalties will be imposed on you, and the assessment will be added into your system. So we have to be very careful and ensure that the import duty that we pay are at the correct rate, to avoid issues with KRA and also to avoid KRA audit queries. We also have the import declaration, also at fee 2%. the railway development levy at 2%. Apart from the customs, we have the excise duty. Most of the time, excise duty is usually referred to as sin tax. I don't know what's so sinful about excise, the commodities in the under the excise excise duty regime. So we have some of the items include alcohol. Oh, that makes sense. We have alcohol, we have soft drinks, a lot of cosmetics and plastics. They're usually under the excise duty. The legal basis. The legal basis is the EDA Act of 2015, which all the items that are exercisable, they are under the EDA Act of 2015. But it's also, there have been subsequent amendments on the same. It will be about adding and removing some of the items that the excise duty regime. For definition of the time of supply, excise duty is payable upon removal from factory. So after let's say you are dealing with alcoholic drinks, after they have been manufactured, the point of payment for excise duty is when they're being removed from the factory. Now that is where the issue comes. Because excise duty, when it comes to audit, they usually do a forensic audit. So when they look at your system, when they do the audit on your systems, they say on a particular date, the amount of there were 10,000 bottles of the beverage that they were manufactured. But what you paid for 8,000 bottles. So they'll ask you now, these 2,000 bottles, why was excise duty not paid on them? And we say, and as I've said, when it comes to excise duty, KRA doesn't do just like an ordinary audit. They usually do a forensic audit. So to avoid issues, ensure that all goods that have been manufactured, by the time they're moving from the factory, all of them have got excise stamps. And currently, the excise stamps are automated. They are automated and they follow a serial code. So basically, especially with the introduction of even the apps such as the Soma Label app, your stamps can be easily verified to determine whether they're legit or not. So it will end up giving you a lot of penalties and fines and assessments as far as KRA is concerned. So let us all be careful about that, especially for those of us who deal with exercisable goods. And a larger part of excise duty has been covered in our master classes, both online and physical. And every kind of tax that we are talking about today, they have been comprehensively covered in our master classes. So the next time that we advertise a master class, make a point of coming to learn and having an in-depth understanding of all these aspects. Also, for excise duty, we have the license. We say licensing is mandatory. It is not optional. If you're dealing with an exercisable good, you have to have a license on them. You have to pay for every item. You'll find that in big companies, we basically have a KRA appointed guy who is stationed there to ensure that all goods have been have been accounted for. But that usually happens to very large manufacturing companies with very heavy or rather very high outputs. So KRA usually sends one of their own to ensure that all the products have been accounted for. So the risk areas, as far as excise duty is concerned, number one is underdeclared production volumes. As I have described before, whatever has been produced and whatever has been exercised, they are different. So it gives a risk. Also, we've got excise stamp irregularities. Basically, these are stamps from River Road. They are not authenticated by KRA. So you have to ensure that, and sometimes it goes deep. You ensure that you get your stamps from authorized KRA offices. Just because it's a KRA person giving a stamp does not mean that they're legit. So you have to be very careful, especially the backdoor stamps. I have seen it give a lot of guys a lot of issues as far as KRA is concerned. So ensure that all your stamps are legitimate. And as we've said, currently they are automated. So it is so easy for you to be found out. And also we have got incorrect tariff application, whereby you apply a lower tariff compared to what your goods are supposed to be applied on. So you end up paying less taxes. So in case of an audit, you're going to pay up the difference plus interest and penalties. That is basically about excise duty. I'd like us to look at the payroll taxes and the statutory levies. Payroll taxes, usually, because as we have said, manufacturing industries are very heavily reliant to human capital, so they end up employing a lot of people. Yeah, from the management to the consultancy to the experts and professionals to the grounds people to the casuals. So you have to ensure that you comply fully to Section 37 and ensure that you deduct pay from your employees and remit the same to KRA. Usually it's done by the 9th of the following month. Failure to which the penalty is 10,000 or 5%, whichever is higher of the tax payable. It is usually the penalty. So ensure that you file your monthly returns on a monthly basis as far as pay is concerned. One other thing that affects pay, the other thing that affects pay are directors' drawings. Let's say you have a manufacturing company and you're a director. So in case of a review, what will happen is KRA will look at the amounts that the director withdrew from the company. And that not only affects manufacturing industry, but it affects all kind of businesses. So the director withdraws money and the money is not properly accounted for. When they look at the debits, their first area of interest is usually withdrawals, cash withdrawals. That is number one. And then they go deeper and look at the monies that have been withdrawn by the director. So every amount, any amount that has not been accounted for, usually taxed under under the director's remuneration. It is basically what it says is basically the director paid themselves through the drawings and the same was not declared. So you have to be taxed on that salary, to say the least. So one other thing that usually brings about issues as far as pay is concerned is misclassification of casual laborers to avoid paying pay. So if there is a particular person year in, year out has been classified as a casual, he is paid either on a monthly basis or twice every week, and the name is consistent. What KRA will do is they will reclassify that from casual to an employee. Because casual, these are people who you can work with for a few days and then they go. But now in your payroll, you find that it's the same person, over and over again. Every month. KRA will reclassify that into an employee. And the same way, they'll be charged to pay you the same. And also the housing levy and the NIDA. So we have to be very careful about our classifications. And also, one other thing that affects the pay is the housing, the transport, and the staff meals, as described under Section 5. We know that staff meals have a limit. We know that things like per diem have limits. Also, the housing and also the transport allowances. So we have to make sure that all allowances, as far as all employee expenditures, are in line with the Income Tax Act, to avoid a lot of issues with KRA, because we'll find that some of us, instead of charging them as allowances to, or rather adding them as allowances to employees, we end up expensing them. Such amounts are usually disallowed, and you pay taxes on the same. So you have to be very careful about overtimes, about house allowance, about shift workers, about casual workers, about the staff meal that you produce, you give them. Are they above the prescribed rate? If so, then the balance is supposed to be added on the employee. About the per diems, it was raised from 2,000 to 10,000. Any amounts above that, then you're supposed to add them to as an allowance to the employees. So we have to be very careful as far as pay is concerned. It might not look like a really major tax bracket as far as KRA is concerned, or rather compared to income tax and VAT. But if not done properly, it will give you a lot of issues that were easily avoidable. If you fail to withhold pay from your employee, when KRA comes, you as the employer is the one going to bear that brunt. So basically, it means your staffing costs have gone high than earlier anticipated, which will hurt the profitability of the organization. So let us be very careful about when handling such kind of items to avoid a lot of issues with KRA. I really hope that is clear, and I'll still reiterate, if you have got any queries, Please do not please do not hesitate. You can ask your questions, and we will try as much as possible to ensure that your questions are being asked, are being answered, all of them. Yeah, I can see that the chat box is really busy. The chatbot is really busy. So basically, it's an encouragement that people have got pertinent issues and they're also listening. If I could look at probably one or two questions. So someone is asking about the notes here. A link will be shared on the same. You'll receive a link which will be inclusive of the notes. So someone, Isaiah, is asking what is the tax position for someone engaged in water refilling business? For water refilling business, for bottled water, they're exercisable. So yes, you have an excise duty obligation as much as KRA is not has not penetrated to the estates, but sooner or later you're not exempted both excise duty and VAT. So someone asked me, what if I fail to pay nil returns or pay for about 3 months or so? Will you be charged 10K? Yes, we'll be charged 10K for every month. Leave alone 3 months, 3 years or 10 years, it will be consistent. You have to, if you do not have employees, you're supposed to file nil returns. But if the company is operational, the director is by default an employee. So you cannot be filing nil returns under payee and you are the director and the company is functioning. In the only areas where you can file nil returns is when the company is not functional. But if it is, then you as the director, you're the first employee. So you are supposed to file returns as far as pay is concerned. Someone is telling me that I'm breaking. I hope I am clear now. I really do hope I'm clear now. And we are not lost. Let me look at another question. So do not be worried about some of the questions. Sorry about that. All right. I can see the engagement is very constructive. I can see the engagement is really constructive. Probably I could look at another question. So someone is asking, what happens to expenses that are not ETIMS compliant, e.g. transport services like pickups? They will not be allowed for expense purposes currently in this regime. So ensure that you deal with people who are compliant. Please ensure that you deal with people who are compliant with ETIMS, because failure to do that, then you won't be able to. You're not going to be able to claim. I don't know if we are making sense. So we are being so someone is asking about a petty cash. On petty cash, for instance, I purchase supplies from Naivas worth 10,000. How will this reflect on my ETIMS and Naivas doesn't have my KRA PIN? You're supposed to give out your KRA PIN to Naivas. So before you go and actually purchase, before you go and do the purchase, you're supposed to clarify to them that you want an ETIMS receipt. So basically what they are currently doing, they will add your PIN. They will add your PIN to their system so that when you're paying for the goods, you're going to receive your receipt, which will have ETIMS. So for emoluments, for salaries and wages, for emoluments, they're exempted from ETIMS. So all matters of salaries and wages, all of them, they are exempted from ETIMS. So you're not going to require any ETIMS on that. So there's no worry about that. So as your questions are being answered, we'll go back to our review, because rather our webinar, our notes. We want to look at the levies, also the incentives, and the KRA audits, and we will look at a case study of the same. Okay, so I hope we are having our questions answered. Now, if we look at the statutory levies, some of them they include, they affect the payroll. We have the NSSF, the SHIP, the housing levy, and the NITA. So let us look at regulatory levies briefly. These are basic. There are two types. We have the standard levy and the county cess. This is for agro-processing industries. For standard levies, usually at 0.2% of the turnover. but this is basically usually the net of both excise and VAT. It is currently capped at 4 million. Before that, it was capped at 400,000. So when Parliament sat down, they decided that the best way approach is by increasing the cap on soda levy by 10 times. I do not understand the essence of that, but currently that is the law. So you're supposed to pay 0.2% of turnover, but it has a maximum amount of 4 million. Failure to do that, you will incur a penalty of 5%. So especially for those of us in the manufacturing industry, let us keep conversant with the standard levies. So I'd like us to look at tax incentives. Tax incentives as far as manufacturing industries are concerned. I'd like us to look at both the EPZ and the SEZ, and also the investment structuring strategy. So exports processing zones, these are basically zones designated by the government for export purposes only. So the incentive under the EPZ that usually given is the income tax for the past 10 years is 0%. Then for the next 10 years is 25%. So industries in the EPZ, they do not pay any taxes in the income tax for the first 10 years. Then number two, after the 10 years have lapsed, they pay their income tax rate is 25%. So basically, this is usually done to encourage exportation services, which improve the balance of trade for the economy. And also their VAT is zero rated because they deal with export service goods, exportation of goods. So, but they have to be in this specific designated areas as far as the government has designated. Number two, we have got the special economic zones. Special economic zones, they're not restricted because they do both exports and local. So for the export, for the special economic zones, I think in Nairobi it is somewhere in the Nairobi gates, somewhere along the Eastern Bypass. So in those special economic zones, the goods and services there, people in the special economic zones, their income tax rate, the corporate income tax rate for the first 10 years is 10%. Number two, we have for the next 10 years. For the next 10 years is 15%. So you'll basically, for the first 20 years, they are given a very big tax incentives. I don't know how legal it is, but I see people in the EPZ and SEZ before the lapse of the exempt, or rather the first 10 years, they reinvent themselves on new companies and then they start enjoying it again. So as this reduced rates, these are some of the incentives that are given to the manufacturing industry that there are both in the SEZ and the EPZ. So some of the investment structuring strategy that can reduce your, that can help plan your taxes is, we have number one, we have export percentages. We have learned that exports are zero rated. So if you have got a higher percentage of your goods that are zero rated, you'll end up getting refunds. So, and that will reduce your VAT liabilities. Number two, we have capital intensity. We have seen that we have capital allowances as far as capital expenditure is concerned. So, and the capital allowances are used to reduce the taxable income. So, if a company invests in capital assets, then they will be able to claim the same as under capital allowances at their different rates. So it is also one of strategy that a manufacturing company can use to plan for its taxes. Also, we have got long-term profitability. If your profits are spread, it will, in the long term, reduce your taxes. This is because as time goes by, you'll have more and more allowable expenses to reduce your taxes. And also the capital allowances, because they are spread over, you do not claim. There are those like furnitures. It is when there is a 10%, we have motor vehicles, 25%. So for 10%, that will take 10 years. For 5%, for 25%, it will take 4 years. So the more you spread the more your profitability is spread, the more you can be able to enjoy these capital allowances and basically reduce your taxes. Also, we have got the debt structure. If now, even for directors, as you are investing in the company, we have two items. We have two items. Number one, we have capital injection by directors. And then number two, we have loan from directors. They're usually treated differently. If a director invests in a company, or rather through debt, they're allowed to claim the interest expenses, which will reduce their profitability. So if you've got a higher debt to equity ratio, that means your profitability will be lower, because you will be able to enjoy, or rather you'll be able to deduct more interest income on the debts that are being paid. But just a point to note, the debts are not supposed to be in theory. They're supposed to have a loan schedule and a loan agreement of the same. And also your bank statements are supposed to show that there is a structured way on how the debts have been repaid. So you cannot just say that I'm the director, the money is the variance in my debits, or rather the profit that you say that I get when you have done my bank analysis, this is money that I invested, that I loaned the company. So the withdrawals for payment, and there is no structured way to show it, it will be disallowed. Also, you cannot say that you invested 5 million in your company, and in your personal PIN, you're filing nil returns. Where did you get the money from? Unless you're a magician. So these are some of the questions, even while you are coming up with such kind of structure, they're supposed to be documented to ensure authenticity. I hope that makes sense. So finally, I'd like us to look at KRA audit focus before we look at a case study. We'd like to look at areas in which KRA focuses when they're doing either a review or they're doing an audit in your manufacturing company. Number one, we've got ETIMS invoice matching. What basically this means is, if I have an ETIMS and I declare the invoice. If I have an invoice and I declare it both for income tax, both for VAT and currently for income tax, then the person that I acquired the invoice from, my supplier is also supposed to declare the same. Failure to which the invoice is going to be disallowed. But currently this has been made easier by the use of the auto-populated. So it has made things a little bit easier. But there has to be a match between what the supplier is declaring versus what me as the buyer is also claiming. Number two, we have got the VAT refund integrity. This is basically, it affects people who are largely in the export business, claiming for refunds. One or the other carrier will have to verify the authenticity of your inputs. So it's not about going and just finding invoices that have VAT and then claiming because you're doing export businesses. Here we look at number one, to look at if the input was used for the production of the zero-rated output. Then number two, it will look at the authenticity of your supplier. Are they missing traders? Is there a paper trail that that can show that this transaction actually happened? And then number three, it will also look at the export documents. The goods that you claim were exported from Kenya, is there documentation to show the same? So all these have to be looked to ensure that all refunds are of integrity and they are legit refunds. So in the recent past, we have seen KRA try to speed up the process of refunds, which is a welcome move. This will go a long way to ensure that the cash crunch in companies is kind of reduced. And then number three, we have about the transfer pricing margins. This is basically affects especially companies that are dealing with multinationals. So it affects both ways. Number one, if the company is acquiring its input from outside, especially from a related party, the prices that it pays for its inputs, are they at arm's length? If they're not, then the transactions are reviewed. Number two, if you're exporting and you're exporting to a related company, the prices that you are charging, are they higher than the market price or are they lower than the market price to avoid profit shifting? So the margins have to be the same as the market rates. The transactions are supposed to be the same, like if you're not dealing with the person whom you're related to. Also, we have number three about customs valuations. Mostly the import duties. Which rate are you using for which item? Are they in the correct HS codes? If not, then it will raise a query. Then you have got capital allowance claims. If your capital allowance is oddly large or oddly high consistently, it will raise a query because high capital allowance claims lead to low taxes, and KRA is really focused on taxes. So if their taxes reduce, then they will come for you and ask and have an inquiry on the reason as to why, for some reason, their taxes have gone low. And then we have thin capitalization, which I have covered earlier. So they'll just ask, what is your debt to equity ratio? If it's higher than 3:1, especially for foreign controlled entities, then any excess of that is disallowed for tax purposes. Also, we have the excise production verification. This affects excise duty. If you produce exercisable goods, is the amount of production the same as the amount of excise duty paid on those products? So they have to verify. If there is a mismatch, then it creates audit queries and audit triggers. Number two, currently, there is sometimes they walk around, especially in supermarkets and shops, and they buy a product that's exercisable, and then they scan the code. If the excise stamp is not valid, then you're in trouble. So these are some of the areas that KRA focuses on. And also, probably what I also mentioned is director's drawings. As I have explained, they bring, it gives rise to pay assessments. So let us also be very careful while handling that. And also classification. In the recent past, I've seen a lot of, especially as far as pay is concerned, I have seen a lot of companies reclassifying the employees to consultants rather than employees. So the question that you're supposed to ask yourself, do they meet the threshold of a consultant? Because if they don't, then you're going to bear the brunt of the pay. Because originally, the person who is supposed to be deducted pay is the employee. So if you did not withhold the pay from the employee, and then you're assessed and it found that you wrongly classify them as consultants, then you're going to pay the resultant pay that your supposed employee was supposed to pay. So as I've said earlier, as much as we would want to reduce our taxes, but it's so hard to automate the system. There might be loopholes which are existent, of course, which I do not know, but compliance is the easiest way of profit savings, because some of the methods that we use, they might work for now. But remember, KRA has got the authority to audit your books for 5 years. So they may not come for you right now or the year after. But in 2030, they may come for you and then they say, now produce your books from 2026. And that is when all these tax, for the lack of other words, tax evasion strategies were being constructed or being done. So at the end of the day, we're going to pay the monies. So compliance. That is the gospel according to RWK Africa for today. Let us ensure, let us strive for compliance to avoid, because whether you like it or not, the cost of compliance is relatively lower compared to the cost of evasion. And this can be done by ensuring that you have proper books of records, ensuring that you work with close with a tax consultant for tax advisory matters, and also ensuring that you pay your taxes in time. So please let us try and ensure that we strive towards that. So as far as the manufacturing industry is concerned, the checklist of management of risk are involved. Number one, if you're a multinational, if you're multinational and you are dealing with related parties. Number one, ensure that your transfer pricing documents are current. In the Finance Act 2025, there was something called the APA, the Advanced Pricing Agreements, whereby you can agree in advance, also with KRA, the prices that you're going to charge on transactions relating to related parties. So ensure that your documentation is current. Number two, ensure that all your invoices are ETIM compliant and they're validated. Having an ETIM receipt does not mean that they're validated. Ensure that they are validated. And then we have got the customs classification review. Ensure that the duties that you pay are of the correct rates. Also ensure that you reconcile your schedules as far as capital allowances are concerned. Ensure that, because if you do not do that, you might end up claiming more capital allowances. That is, if you do not put factors such as disposals, depreciations, and additions into consideration, you might end up miscalculating your capital allowances, which would bring issues with KRA. Also ensure that your exercisable goods exercisable returns match with production. What you produced and what you've paid for excise duty, they are the same. Also, for refunds, ensure that your documentation is complete. As you've said, invoices are not evidence enough. They have to be proven that they actually occurred. Also, the supplier compliance, you might, while transacting, do your due diligence to ensure that also your supply is compliant, to avoid your invoices being rejected and you end up paying the resultant taxes. Because even if later the supplier gives you a credit note, but at the end of the day, you've already paid these taxes. What happens when you already have a credit balance after that and you've paid the taxes? The credit balance cannot be used to offset VAT assessment backwards. So ensure that you review the compliance of your supplier. Finally, I'd like us to look at a case study. I'd like us to look at a case study and see how the points, or rather see the areas in which this case affected, and what was the outcome. So the case was the Republic versus KRA, Expate Cooper Brands Pay Limited. So for a little background, Cooper K Brands, which is a pharmaceutical manufacturer of animal and plant products since 1906. It has got more than 130 employees, and it had 300 million plus assets. So what happened? KRA audited 31 pharmaceutical companies which are related to Cooper brand. The demand letter for 26 November 2013 had 161 million in unpaid import VAT. That was for the period between January 2008 to October 2013. So here's the catch. KRA's own Simba system, called B0 to 60, had computed zero VAT on every import for 12 plus years. That is one. Number two, KRA officers physically verified and cleared all consignments throughout. So in the Finance Act 2001, the zero rating and exempt had been removed by the Finance Act. So basically it meant that these items were vatable. I don't know if you're getting me. So from 2001, these items were vatable, but now KRA continued clearing its imports at exempt. And as you have observed earlier, it is KRA's own SIMBA system. This is the system that is used for customs. So I had completed zero VAT, and that was the 12 years. And also, KRA officers were the ones who were physically verifying all the assignments. So these were the legal issues. Number one, whether VAT was legally due, because it is in the law. The law from 2001 removed the exemption and zero rating on the supplies that these guys were dealing with. Number two, whether KRA's conduct created legitimate expectations, because they were being verified by a KRA official, and it was in the KRA SIMBA system. Number three, whether the demand was an abuse of power. Then number four, whether tax compliance certificates bound KRA. Then lastly, whether judicial review was the right form or the right forum. So for the first, under the orders and the takeaway, number one, the orders under VAT, were they legally due? The answer is yes, because the Finance Act removed the zero rating policy, and policy cannot override the statute. But courts did not decide this case on this point. So if the case was solely dependent on legality, then yes, it was legal, because of ignorance is no defense. One of the things that was the prayer of the owner or the director, they never knew about it, but that was no defense. So yes, it was legally due. Number two, legitimate expectations. Was there legitimate expectations? Legitimate expectations is whereby I am the customer and you're KRA. So I expect you to be doing the right thing when I come to you. So if for 12 years you have been clearing my products under one code, and there was an active officer verification, which was the regular practice, then that means I could reasonably rely on your judgment to be right. So that was the court decision. That was there a legitimate expectation? Then the answer was yes. Then you have got abuse of power. Was there abuse of power? The court ruled that yes, KRA inaction caused irreversible harm. Because number one, these items were being cleared under the wrong HS code. And this was easily verifiable under the SIMBA system. And then it was a KRA official who was physically verifying the items. So was there an abuse of power? Yes. KRA's inaction caused irreversible harm, because the applicant lost VAT refund rights. He could not have a refund because the items were time barred. And he did not have the ability to adjust the prices to input the VAT aspect. It also imposing the liability after removing all recourse was disproportionate and conspicuously unfair. So there's no recourse because you cannot have your VAT refunds, you cannot adjust your prices to factor in VAT. So the court found that it was conspicuously unfair. What about the tax compliance? Because what the pharmaceutical companies say that we have been having a compliance certificate. but the courts say that the reputability of the tax compliance is only prima facie only, because the fact that you have got TCC doesn't mean that you are you cannot be audited, or rather your books are 100% okay. KRA still has the right to cancel that TCC even on those years that you actually had them. So these are the orders. The demand for 161 million was quashed, prohibiting KRA from enforcing the assessment. KRA was also ordered to pay 11 million in VAT refunds, and no order as to cost. So as such, KRA lost. So this is the takeaway. KRA was likely legally correct, but its own system and officers signaled otherwise for over a decade. By the time it acted, the applicant had permanently lost all available remedies. Fairness, proportionality, and legitimate expectations under Article 47 required quashing the demand. So consistent administrative practices by a public body can ground legitimate expectation even without an express promise. Delayed enforcement strips the taxpayer. So as such, KRA lost. So in conclusion, manufacturing taxation in the manufacturing sector is usually multi-layered because it involves a lot of layers, from inputs to processing to works in progress. So it is very multi-layered. It is also very audit intensive because it captures a lot of items under it, and a lot of, even in a tax, even in an audit, it is very, very intensive because it involves a lot of aspects. And then it is very capital intensive because the purchase of machineries and equipment usually very capital sensitive. And we have refund sensitivity because especially those dealing with exports. Yeah, so those are some of the points to note under manufacturing. So probably a take home is proper planning reduces taxes, but poor documentation exposes the entity to severe penalties. You may plan, but if there's no documentation, you will be exposed to a lot of audit queries. As we are winding up, I hope your questions are being answered by our team. So just to mention, I have a few announcements. Number one, we have a CEO's breakfast meeting. This is basically all the economic drivers, basically CEOs. They are invited for a CEO's breakfast meeting. And the theme will be navigating e-teams, which is the new tax reality, and also using AI to drive business success. They only say that the only thing that is constant in this world is change itself. So we have with the times, let us accept the new AI reality, the new e-teams reality, and let's come and let's have a conversation over the same. The charges are 3,000 shillings, and it will be on the 19th of March, starting from 9 a.m. to 12 p.m. So all are welcome. In case you want, you can on board. Then next week on Friday, on the 20th of March, we shall also have another live webinar by Dr. Regina Kimori. Our webinar next week will be on tax audits in this era of e-teams. So this is not a webinar that you'd want to miss. Plan for the same. So for the we have also our masterclass trainings, as I had mentioned earlier. Last week we had our physical masterclass, which was on 4th to the 6th of March. Currently ongoing is the online masterclass, which is usually daily from 7 p.m. to 9 p.m. It is not too late for you to join. Also, in May, we shall have an audit and bookkeeping masterclass from the 6th to the 8th. And also the same online will have another online on the audit and bookkeeping masterclass from the 11th to the 22nd of May. In August, we'll have another tax masterclass, which will be physical from 5th to the 7th, and August and online from 10th to the 21st. And in October, we shall have another audit masterclass, and the same, both online and physical. So let us plan to attend. We also have a free training, which is called the Skill Up Mentorship Program, which it will be free. I know we love free things. So we had in mind, we are not only concerned with your taxes, but also your growth. So what shall be covered will be animal feed formulation, mushroom farming, rabbit farming, and beekeeping. This will be on the 21st of March, that is next week on Saturday, at Thika Road Technical College, Ndarugo, opposite PCA Church, Ndarugo. So let us all come. It's a free training. Let us come and skill up. So our services, we offer tax services, which include health checks. We do refund processing, we do planning, we do representation on reviews, we do audit reviews, we do KRA reviews and advisory on tax implication on various transactions such as mergers, such as transfer policy documents. We also do tax training such as the masterclass. So please come on board and let's have a conversation. We also do audit services, which are usually very comprehensive. So especially as we're entering the filing period, get in touch with us. We shall audit your books and give you peace of mind. We also have internal audit and bookkeeping services. So if you're interested with the internal audit and bookkeeping services, we also offer the same. Finally, from the point of no, we actually discovered there was a gap between proper bookkeeping and proper documentation because we have been in the industry long enough. So being a solution-centered institution, we came up with a system that helps you to keep your records accurately. And we came up with a system called My Accurate Books, which basically covers every bookkeeping aspect and every record keeping aspect. So if you're in business and you're looking for a solution as far as your records are concerned, we have that system. And I would like to invite my colleague to just for the next brief 10 minutes to give you an overview of the system and how it can be helpful to your business. Otherwise, thank you so much. Looking forward to having another conversation with you. Thank you.
So good afternoon. So I'm going just to dive into it right away so that at least we get to take the shortest time possible. Set up the drafts for okay. So in a few, I will be setting up the My Accurate Books accounting system account so that at least we get to interact over it through this session. And at least we get to see maybe some of the basic features that we get to interact with and how best My Accurate Book system is able to address the concerns that we have in our businesses in terms of proper record keeping and also accurate reporting. So basically, the system has a number of features that will enable us get to streamline our daily operations in our businesses. So my accurate books accounting system has actually the point of sell feature sell through the system. Then at that point, you are able to get, instant receipts and invoices that you can get to serve your customers with. And we'll also be in a position also to manage, the customers that we frequently get to serve from time to time. So we can get to keep a database of the customers that we interact with much of the time. And then we also have, the item management feature. So with that, we will be in a position that we have, so that at least you can always get to set maybe some reorder levels. Say at which point do we now get to act our suppliers for more whenever there is a need for restocking. There's also a payment integration feature of the same. This is whereby now we can get to incorporate the other alternative payment methods that we might be having in businesses. Say, for instance, maybe if we have the till numbers, maybe the pay bill numbers, and also maybe linking them to your bank accounts, we can always now get to initiate them in the system so that the client can receive a prompt and, complete the payment on their end. So with that, let's just dive in right away to an account so that at least we get now to, interact together over the system and then get to learn some of the basic features of the system. So with that, I'm going to log into one of the accounts here so that at least you can be able to see some of the basic features for this account. So let me just start right away. So we have this as our account that we are going to use to interact through the system. We have kids 2002 at gmail.com. So at the end of the session, just in case you might have any more concerns regarding how my Accurate Books accounting system works, I'm going to leave you with some contact details so that at least you can raise your concerns over there and they will be addressed to accordingly. So for this, I'm going to have it as Moteria 2026 hash. And then now we get to log into the account. So basically, this is how the system looks like. Whenever you log into the system, this is the landing page of the system. So basically, we have the dashboard analytics. You'll be able to filter out the kind of reports that you want to interact with. And then you'll be able to fast track the sales revenue that you make on a daily basis or over a period of time under the sales segment. And then you can also be able to keep track of the expenses that you incur in between your daily operations. So you'll always be able to fast track the expenses under the expense management bit. And then you also have the purchases bit. This is whereby now you'll be able to fast track the orders that you get to raise to your suppliers from time to time for restocking. And then lastly, you have a P&L analysis of the same, just to ascertain the position of your business in terms of profit and loss. And then now with that, perhaps maybe we can now get to see some of the basic features of the system. Basically, we have the inventory bit. So under these products and services, you'll be able now to keep a list of the items that you have in your businesses in terms of stock. And then at that point, you can always be able now to keep track of the stock that you have over the system. And then whenever you want to initiate a sale through the system, you can always now get to click on the sales bit and then initiate a make sale. So under this, you'll be able now to initiate all your sales through the system, and the system itself will be able to automatically generate instant receipts and invoices that you can always get to serve your customers with whenever you transact. And then there's also the feature of quotations, whereby now you can also get to generate this over the system, perhaps now get to make a new quotation. So you can always get to initiate the same from this point here. Once you click on new quotation, then at that point you are able to capture all those necessary details and come up with a quotation that you can get to serve your clients with. And then you also have the purchases bit. So under this, you can now be able now to raise purchase orders through the system. So you only need to click on the purchases order part, and then from that point now, you'll be in a position to create a purchase order. And then down below here, we have the debit notes. So at this point, you'll always be in a position, to make a debit note. Say, for instance, maybe if one of the products has been delivered while, broken or maybe spoiled, at that point, you can always get to raise a debit note through the system. And then you also have the aspect of paying for a purchase. And then now down below, you'll be able to keep track of the most critical thing. The other critical aspect for any other business will be the expenses bit. So under the expenses, you can be able to see the expense dashboard. And then now under the expense management bit, now at this point here, you can now be able to fast track the expenses that you incur from time to time in your daily operations. So we have actually the several maybe types of some of the common types of expenses that most businesses incur are actually in the system already. So you can always get now to fast track the same through the system. And we also have now the reporting bit and also maybe the customers. Under the customers now, under this point, you can be able now, to create a customer list. Maybe a list comprising of some of your frequent maybe customers that you get to serve from time to time. And then there's also the accounting segment of it. Now for this, you'll be with the system, you'll be able to interact with the charts of accounts. There's also the journals entries, whereby you'll be able to also see the assets reports, the general ledgers, the trial balance, and also the balance sheets, and also be able to see the cash flow of your business, how it's performing. And then there is also the reporting aspect of the system. So under this, the system is able to generate a number of reports. So basically we have the inventory report. The system can be able to generate the inventory report for you to be able to fast track, how your stock is performing. And then there's also the P&L analysis of the same. Now, this is a more detailed report in terms of the revenue that your business is generating against the expenses that you get to incur from time to time in your daily operations. So at a glance, you can be able to tell how your business is performing in terms of profit and loss, because the system will be able to automatically get to generate that based on the entries that you get to make on the system. And then the system also has, the customer report. You can also be able to see maybe the debtors report. You can also be able to interact with also the creditors report at the same time. So you'll be able to see, an analysis of all the creditors that you might be having under your enterprise. And then there's also the sales report, just to be able to fast track maybe which type of product is selling out fast in your enterprise, so that at least you can always be able to plan early enough on which one to restock and maybe which particular kind of product that you need to do away with, that which is not performing quite well. And then there's also the user management feature. So basically this feature enables us to get to add other users under the same account. So if you might be having maybe an employee in your business, that an employee who is normally in charge whenever you are not around your business, then at that point you can always get to add them as a user, and they will be able to initiate everything through the system, so that at least you are always able to monitor through the same account wherever you are. And then the system is also able to manage a number of branches under the same account. So under the branch management, under this bit here, you can be able to add a branch. Say, for instance, maybe you have your business in CBD, town, and maybe you have another branch, say maybe along Mombasa Road. So you can always get to add the other branch also under the same account, so that you can always be able to switch from one branch to another to see how both entities are performing. And then we also have the other feature, which is the customization. So you can always get to customize maybe the invoices that you get to generate. And for this, you need to be able now to upgrade to a certain package. So basically, the system is on a monthly subscription. So under this, you're able to see that the system is on a monthly subscription. So basically, we have two main packages. There's a standard package and the gold package. So they both differ in terms of the features that they have. The gold package is more comprehensive and has more advanced accounting features as compared to the standard package. But then again, both packages can still be able to assist you streamline your daily operations quite well. So with that, we also have the quarterly package. So for the standard package, 1 month goes for 500 shillings a month, and you get to use that system for the entire period of 1 month. And there's also the gold package that goes for 800 shillings a month, and then you'll be able to use, and interact with the accounting features under the gold package for 1 month. And then there is also the quarterly subscription. So for the standard package, it goes for 1,400, and this is for 3 months, and you get another month extra. So once you pay for the standard package 1,400, you'll be in a position to make use of the system for the entire period of 4 months. And then there's also the gold package for 3 months, and you get a month extra. This also goes for 2,200. And then there's also the semi-annual package that goes for 2,800, and this is for 6 months, the standard package. And then there's also now the gold package that goes for 4,600 for 6 months, and you also get a month extra for the gold package. And then the yearly package also, the standard package stands at 5,500, and that you get to use the system for the whole year uninterrupted. And then you also have the gold package that goes for 9,000 shillings, and for this you get to make use of the system under the gold package for a whole year. I understand that we might be having maybe points of concern that require some clarification. So maybe for any inquiries or clarifications that you might be having regarding my accurate books, you can always now get to reach us out through this number for more clarification, and we will get back to you regarding any issue or concern that you might be having regarding my accurate books accounting system. So we can be reached through this number 011 6 333 000. So our phone number is for my accurate books accounting system. For any points of concerns that you might be having or inquiries, you can reach us out on 0116 333 000. 011 6 333 000. With that, not unless maybe you have any other concern, you can allow me now to stop at that point. hata nimekafunga tu saa hii.